6 days. That is how long Comex has before March 1st notice day. And right now, the math does not work. Silver just hit $84. Comex registered inventory fell below 100 million ounces for the first time this cycle. March contracts represent 240 million ounces of demand, and the banks have 6 days to make 98 million ounces cover 240 million in claims. This is not a theory. This is not a prediction. This is math, and the clock is running. Stay with me, because what I am about to show you is the difference between understanding what is happening and watching it happen to you. Comex registered silver, the metal sitting in vaults that is warrant issued and actually available for physical delivery against futures contracts, fell below 100 million ounces on February 11th. 98 million ounces, that is where it sits right now. March open interest converted to ounces sits at roughly 240 million. The gap between those two numbers is the implied deficit. And when you divide that deficit by the daily rate of open interest reduction through the roll process, you get a timeline. At recent roll paces of 20 to 30 million ounces per day, that timeline points to Comex exhausting its registered silver before March settlement completes. Pull the Comex vault reports yourself. The data is public. CME Group publishes it daily. Check it. Now, before anyone turns that into a doom headline, here is exactly what it means and what it does not mean. It does not mean a default happens on February 27th. It means the roll must continue at pace, or physical inflows need to materialize for the market to clear March without stress. But here is what should terrify anyone paying attention. From April onward, this market runs into a structural shortage. Unless new silver enters Comex vaults in meaningful quantity over the coming weeks, March is no longer the bottleneck. April is the next pressure point, and the ones paying attention are already watching those inflow numbers. Here is the data point that changes the framing entirely. There are still roughly 200 February contracts showing sticky open interest. Holders who by every indication are sitting there demanding physical settlement and waiting to receive the metal as fast as possible. In any normally functioning futures market, these positions clear without drama. The fact that clearing them has required this much effort tells you something about the physical appetite underneath this market right now. The week opened with plenty of noise. Social media was flooded with declarations that silver would crash because China was closed for Lunar New Year. The theory was that with Asian buyers offline, the banks would have free rein to slam the price. And there is truth to that concern. Low liquidity periods like holidays do present a window where concentrated selling can move the market with less resistance. That is a real dynamic. The holiday runs through the 24th, so we are still in the window. The thesis has not yet been proven or disproven. But here's what we have seen so far. Silver opened the week around $70. It sits at $84 right now. The expected slam has not materialized through 5 trading days. Volatility actually dropped to its lowest level in weeks. Does that mean it cannot happen between now and Monday when China reopens? No, the window is still open. But the alarm that was sounded, the certainty that this week would bring a crash, has not matched the price action we have seen. And that tells you something about the strength of the physical bid beneath this market. Now let me show you what Hekla's earnings just confirmed, because this is the part that proves the paper market is losing credibility. The real price of silver is not $84. Hekla got paid $69 per ounce in Q4 when Comex said silver was worth $55. That is a 26% premium. Not in Shanghai, not in India. In America, from America's largest silver miner. Industrial buyers are bypassing Comex entirely and paying premiums directly to mines because they cannot risk the paper market failing when they need physical metal to build missiles, batteries, and solar panels. That is not a supply chain issue. That is a vote of no confidence in the exchange itself. Samsung locked up 100% of the output from the La Pria silver mine for 2 years through a direct prepayment deal. Defense contractors are going straight to refiners. Solar panel manufacturers are locking in supply at premiums. These buyers do not care what Comex says silver is worth. They care what it costs to get metal in their hands. And right now, that cost is 26% higher than the paper price. Now let me show you what is happening in Shanghai, because this is where the physical premium story gets even more extreme. Spot silver in China is at $86. Futures are at $88. The premium to Western markets is $6. China returns from its Lunar New Year holiday on February 24th. That buying resumes into a market where exchange inventories sit at decade-low levels, and the front contract continues showing backwardation, meaning prompt physical delivery commands a higher price than future delivery. Backwardation in a commodity market is the market screaming that it needs metal now, not later. That structure does not appear in markets where supply is comfortable. It appears when deliverable inventory is stressed, and buyers are competing for immediate access to physical metal. Think about what that $6 premium actually means. If you can buy silver on Comex at $84 and sell it in Shanghai at $90, you just made a 7% arbitrage profit. Why is that arbitrage not being exploited until the prices converge? Because moving metal from Comex to Shanghai requires one thing: taking physical delivery from Comex. And right now, Comex does not have enough metal to satisfy everyone who wants it. So the premium stays, because the physical shortage is real. Zoom out from the metals for a moment, because the macro context just shifted in a way that makes hard assets the only logical position. Fourth quarter GDP came in at 1.4%, against an expectation of 3%. Final sales were even weaker at 1.2%. At the same time, core PCE inflation printed at 3%, its highest reading since November 2023, and above every forecast. Slower growth, stickier inflation. That combination removes the Fed's ability to cut rates as a relief valve, and historically drives capital toward hard assets as paper promises get questioned. You can verify those PCE and GDP numbers through the official Bureau of Economic Analysis release. Check it yourself. And then there is the Middle East. The U.S. has now assembled its largest military force in the region since the 2003 Iraq invasion. 2 aircraft carriers, 12 warships, fighter jets including F-35s and F-22s, air defense systems, B-52 bombers positioned in Qatar. Prediction market odds of a U.S. strike on Iran by March 31st have surged to 61%, with over $322 million in volume traded on that outcome. Oil has responded, and when energy prices move on geopolitical risk, the broader inflation picture follows, which feeds directly back into the hard asset case. War creates inflation. Inflation destroys currency. Currency destruction drives gold and silver. This is not theory. This is the playbook that has run in every major conflict for the past century. The ones who read James Rickards' Currency Wars understand this connection clearly. When geopolitical fragmentation accelerates, the financial warfare around commodities and currencies intensifies simultaneously. That book was written years ago. The playbook it described is the one running right now. One more data point worth filing. An unusual options position has accumulated on Comex Gold. Over 11,000 call contracts at strike prices ranging from $15,000 to $20,000 per ounce. Expiring in December, gold sits at $5,062. For those contracts to pay, gold would need to roughly triple. Large speculative bets like this appear periodically. Many expire worthless, and most do not carry informational value on their own. But what makes this one worth noting is the context in which it appeared. Added aggressively, even as gold pulled back below $5,000 after peaking near $5,626 in late January. Someone was buying the dip on a catastrophic tail risk bet. That is a data point. It is not a prediction. But when institutions are betting on $20,000 gold by December, while silver sits at $84 with Comex inventory at 98 million ounces, that tells you something about where smart money thinks this ends. Now let me show you the math that keeps me up at night. Because this is where it gets really dangerous. If registered inventory stays at 98 million ounces and March open interest is 240 million ounces, the market is 2.45 times leveraged. Every ounce of physical silver is backing 2.45 ounces of paper claims. In a normal market, that is fine, because only 10% to 20% of contracts stand for delivery. The rest roll forward or settle in cash. But January saw 49 million ounces delivered. February saw a 98% delivery rate. 18 million ounces demanded from 19 million in open interest. These are not normal delivery rates. These are run-on-the-bank delivery rates. If March sees even 30% delivery rates, that is 72 million ounces demanded against 98 million available. If March sees 50% delivery rates, that is 120 million ounces demanded, more than exists in the vault. The only way the market clears is if contracts roll forward at historical norms, or new silver flows in from refiners and miners. The roll process has been working intermittently, but it has to keep working every single day until first notice day passes. And the inflow data has not shown meaningful restocking yet. That is the variable to watch. Now let me show you what happens if the roll process fails, because this is the part nobody is talking about. March 27th, first notice day, contracts come due. Buyers demand metal. Comex looks at the vault. 98 million ounces available, 120 million ounces demanded. What happens next? Option 1, force majeure. Comex declares an emergency. Cash settles the contracts they cannot fill. Metals, futures, trading halts. Every institution that uses Comex for price discovery immediately looks for alternatives. The paper price becomes meaningless overnight. Physical silver is the only market that matters. And physical silver is trading at $90 in Shanghai, $69 at Hecla, and rising. Option 2, Emergency margin hikes, just like January 30th when they raised margins 50% and crashed silver from $121 to $78 in one day. Liquidate the longs, protect the shorts, destroy confidence in the process. But here's the problem with option 2. It worked in January because it caught retail off guard. It will not work in March because industrial buyers are not speculators who panic sell. They are manufacturers who need the metal to keep production running. You cannot margin call Samsung out of their battery production. You cannot force liquidate a defense contractor who needs silver for missile guidance systems. Industrial demand does not disappear because margins go up. It accelerates because buyers realize the exchange cannot deliver and they rush to lock up supply directly from mines. Option 3, let it run. Allow the short squeeze to play out. Silver goes to $150, $200, maybe higher. Banks cover at massive losses. But the system survives. Confidence remains. The market believes in price discovery again. None of those options are good. Every single one breaks something, and we are 6 days away from finding out which one they choose. Here is what I think is happening beneath the surface. And this is opinion based on observable data. Industrial buyers who need silver for manufacturing are bypassing Comex entirely, going directly to mines, paying premiums, because they cannot risk the delivery uncertainty. Samsung needs silver for solid-state batteries. Defense contractors need silver for missile guidance systems. Solar panel manufacturers need silver for photovoltaic cells. They cannot wait for a Comex contract to settle. They are locking up supply now, at whatever price it takes. That is why Shanghai trades at a $6 premium. That is why Hecla realized $69 for $55 silver. The physical market and the paper market are diverging, and the divergence is widening. At some point, the divergence becomes unsustainable. The paper price loses credibility. Industrial buyers stop using Comex for price discovery. Miners stop hedging on futures exchanges. They sell directly to buyers at physical premiums. And when that happens, the paper price becomes irrelevant. The only price that matters is physical. We are not there yet, but we are closer than we have ever been. Every month that passes with Comex inventories lower than the month before brings us one step closer. Every delivery crisis that gets resolved by contract rollovers instead of physical settlement brings us one step closer. Every Shanghai premium that widens brings us one step closer. And one day, probably during a major delivery month, the roll process will not clear the backlog because there will not be enough sellers willing to roll, and that is the day the paper market breaks permanently. I do not know if that day is March 2026. Probably not. The roll process is still functioning. But I know we are building toward it, and I know every month accelerates the timeline, because every month industrial demand grows, every month the supply deficit widens, every month fewer ounces flow into Comex, and every month the math gets worse. Here is the honest bearish case. Because intellectual honesty is what separates signal from noise. Iran and the US could reach a deal, removing the conflict premium entirely. GDP weakness could trigger broad risk-off selling that temporarily pulls metals alongside equities. The Comex roll pace hitting its daily target does not guarantee it holds through the remaining March settlement window. China's return from holiday could be more measured than anticipated. And silver's move through resistance can absolutely produce a consolidation or pullback before any continuation. None of these outcomes would invalidate the structural thesis. But they are real risks, and the ones who manage capital know that probability and certainty are not the same thing. This is financial warfare education. Position sizing and risk management are entirely your responsibility. Now, let me talk about what silver has done technically, because the price action tells a story. Silver has taken out the previous resistance level from February 13th at $79, a level that had been acting as a ceiling. For price to demonstrate genuine continuation intent, rather than using this breakout as a distribution zone, it needs to hold structure on any pullback. The resistance overhead is $85 to $88. That zone needs to be cleared aggressively and without excessive time spent consolidating inside it. If price lingers too long in that zone, it risks grinding momentum sideways and turning what should be continuation into distribution. The question is straightforward. Does price push through $85 to $88 and continue toward $90 and beyond? Or does it retrace to digest the move first? Bottom line, Comex registered inventory fell below 100 million ounces on February 11th, 98 million ounces right now. March open interest represents 240 million ounces of demand. The roll pace must hold, or new inflows must materialize, for the market to clear March without stress. That has been happening intermittently, but it must continue every single day until first notice day. Sticky February contract holders are demanding physical delivery, not rolling. Shanghai is $6 above Western spot heading into China's return from holiday on February 24th. The macro backdrop just confirmed stagflation adjacent conditions. GDP missing hard. core PCE printing above expectations. Geopolitical risk has a specific calendar now, with that 61% strike probability sitting in prediction markets, and silver has taken out a key resistance level and is now sitting at $84. The open question is not whether the structural thesis is intact. It is whether the Comex inflow picture improves before April, or whether the market enters the next contract month with the same deficit math still running. Pull the vault data. Watch the daily registered inventory numbers. That is the live variable that will tell the real story before any headline does. So here's my read. Silver at $84 is not expensive, it is mispriced. The real price is what Shanghai pays, $90. The real price is what Hecla gets, $69 for metal that Comex says is worth $55. The real price is what Samsung is willing to pay to lock up an entire mine's output for 2 years. The paper price is a lagging indicator. It reflects what traders think silver is worth based on futures contracts. The physical price reflects what buyers will actually pay to get metal in their hands. And right now, the physical price is $6 to $26 higher than the paper price, depending on where you look. That gap is the opportunity. For anyone who understands the difference between paper and physical, for anyone who understands that Comex registered inventory at 98 million ounces is not a comfortable level. It is a crisis in slow motion. For anyone who understands that March 1st notice day on February 27th is 6 days away. And the math does not work unless the roll continues perfectly. 6 days until March 1st notice day, 98 million ounces in the vault, 240 million ounces of claims against it. The math does not work. And when math breaks in a commodity market, one of two things happens. Either the paper price becomes irrelevant and physical sets the real price, or the exchange changes the rules to protect the banks and destroys trust in the system forever. Both outcomes are bullish for anyone holding physical silver, because physical metal cannot be margin called. It cannot be force settled in cash. It cannot be rule changed out of existence. It just sits in your hands, worth exactly what someone will pay to take it from you. And right now, that price is $6 higher in Shanghai, 26% higher at Hecla, and rising. If you want to see what happens when 98 million tries to cover 240 million, subscribe, because I will be here every single day showing you the vault data, the delivery numbers, and the exact moment the roll process stops working. This is not hype. This is not a prediction. This is a countdown, and it ends in 6 days. Verify every piece of data I showed you. The Comex reports are public. The COT positioning data is public. The macro releases are official government publications. The ones who check primary sources do not need me to tell them what to think. They already see it.